TAQA is an Abu Dhabi listed stock and one of the largest listed integrated utilities in Europe, the Middle East and Africa. A company that generates power, desalinates water, transmits electricity and pumps oil and gas across 11 countries. For investors, TAQA offers exposure to a rare mix, a stable, regulated utility core sitting alongside global renewables and an international oil and gas business. So, is TAQA a stock worth tracking? Let's break it down. Abu Dhabi National Energy Committee (PJSC) was established on 21st June 2005 by Emiri Decree, created to consolidate Abu Dhabi's power, water and energy assets under one national champion. It listed on the Abu Dhabi Securities Exchange under the ticker symbol TAQA that same year. The company transformed in July 2020 when Abu Dhabi Power Corporation transferred its power and water generation, transmission and distribution assets into TAQA, more than tripling its regulated asset base and turning it into the UAE's dominant integrated utility. One important detail for investors is ownership. Abu Dhabi Power Corporation, a subsidiary of ADQ, itself owned by the government of Abu Dhabi, holds approximately 90% of TAQA, with the remaining shares held by other shareholders including the public. That level of government ownership matters because it ties TAQA's strategy directly to Abu Dhabi's energy security and economic diversification goals. The business is structured around several core activities: power and water generation, transmission and distribution, water treatment and reuse, and upstream and midstream oil and gas operations, mainly in the UK North Sea. On top of that, TAQA holds a major stake in Masdar, the UAE's clean energy champion, alongside ADNOC and Mubadala, giving TAQA exposure to renewables and green hydrogen projects around the world. Now, let's look at the numbers. According to TAQA's official FY 2025 results, group revenue reached 54.8 billion dirhams, broadly flat compared to the prior year. EBITDA came in at 20.7 billion dirhams, a slight decrease from 2024, driven mainly by non-recurring, non-cash charges in the generation and oil and gas business. Net income rose 5.6% year-on-year to 7.5 billion dirhams. Growth in the regulated transmission and distribution of power and water, up around 5%, offset a 20% decline in oil and gas revenue, driven by lower commodity prices and the planned cessation of production at several UK North Sea fields. Capital expenditure jumped 48.4% to 14.5 billion dirhams, reflecting accelerated investment in power generation, desalination and transmission infrastructure, including the 1 gigawatt Al Dhafra thermal power plant. Gross generation capacity stood at over 70 gigawatts, with around 64% of that coming from renewables, keeping TAQA on track with its 2030 growth strategy. For dividend-focused investors, TAQA runs a fixed plus variable dividend model. The board proposed a fixed dividend of 1.5 fils per share for the fourth quarter of 2025, plus a variable dividend of 0.7 fils per share, bringing the total FY 2025 dividend to 4.45 fils per share, up from 4.25 fils in 2024. That works out to a total payout of approximately 5 billion for the year, including the interim dividends declared to 2025. Shareholders also approved an updated dividend policy for 2026 to 2028, keeping both the fixed and variable components, with the fixed dividend expected to keep growing year on year. The first quarter of 2026 showed the resilience of that regulated core. According to TAQA's official Q1 2026 results, revenue came in at 13.7 billion dirhams, down slightly from 14.1 billion a year earlier, mainly on lower oil and gas volumes. EBITDA rose 5.2% year-on-year to 5.5 billion dirhams, held by stronger contributions from joint ventures and associates. Net income attributable to shareholders held steady at 2.1 billion dirhams. Capital expenditure surged 45.5% year-on-year to 3.2 billion dirhams as TAQA kept accelerating investment across power, water and transmission networks. Free cash flow came in at 4.8 billion dirhams, broadly in line with the prior year. The board approved a Q1 2026 interim dividend of 0.8 fils per share, totaling around 899 million dirhams. There have also been major strategic developments to track. First, in August 2025, TAQA agreed to acquire 100% of GS Enima, a Madrid-based water treatment and desalination company, for approximately $1.2 billion. The deal adds around 171 million imperial gallons per day of desalination capacity to TAQA's existing 1,250 MIGD portfolio and gives TAQA immediate access to 10 countries including Spain, Brazil, Mexico and the United States. The transaction is expected to close in 2026. Second, Through its stake in Masdar, TAQA continues to expand globally in renewables, including in early 2026, Masdar and RWE securing contracts for difference for 3 gigawatts of new offshore wind capacity across the Dogger Bank South projects in the UK. Third, in March 2026, TAQA elected a new board of directors with His Excellency Jassim Mohammad Bu Ataba Al Zabi appointed chairman. From an investor's perspective, there are 5 things to monitor closely. First, execution of the 2030 growth strategy and the push toward more than 70 gigawatts of generation capacity, increasingly renewable. Second, integration of GS Enema and process towards sourcing 2/3 of desalination capacity from energy efficient reverse osmosis technology by 2030. Third, the pace of decline in the UK North Sea oil and gas business and how much regulated utility growth can offset it. Fourth, growth in Masdar's global renewables and green hydrogen pipeline and its contribution to group earnings. And fifth, whether the fixed dividend keeps growing through the new 2026 to 2028 policy as promised. TAQA is not a pure regulated utility like some of its DFM peers. It is a diversified group, a stable UAE power and water business, a global renewables platform through Masdar, an expanding international water arm, and a shrinking but still meaningful oil and gas segment. So is TAQA stock worth tracking? Yes. The company has delivered steady revenue, rising net income, a growing capital expenditure program, an expanding renewables and water footprint, and a dividend policy that management has committed to growing through 2028. But investors should monitor the pace of oil and gas decline, the scale of ongoing capital spending, integration risk from acquisitions like GS Enema, and valuation carefully. A diversified state-backed utility is not automatically a buy at every price. This video is for educational purposes only. It is in no way advice or a recommendation to buy, sell or hold any security. Please do detailed research or consult a licensed trading expert before making any attempt. Thank you.